Today we're going to be doing basically a full stock market investing masterclass. Because just the other day I was scrolling through Facebook and I found a post from a young man saying essentially, I want to join the world of investing and learn this stuff, but I have no idea where to start, and can anyone suggest any videos to help get me started? So instead of replying to the post directly on Facebook, I actually just sent him a direct message instead, and I sent him a couple of my past videos. But what I realized when I was doing this is that I didn't actually have one single video that I could send to him that would basically take him from being a complete beginner to the point of really fully understanding it and being ready to confidently make his first investment. So that's what this video is. And this video is not going to be like any other video you've seen. I can pretty much guarantee that, because most videos you'll watch on stock investing for beginners will just give you the definitions of everything, like this is what market cap means, this is what shares outstanding means, this is what a limit order is, and this is what the PE ratio is, etc., etc. And this is great and all, but there's a big difference between knowing a bunch of definitions and having a deep level understanding of how it all works and why. And most importantly, a deep level understanding of how to be successful with it. And so if all that sounds good to you, please hit the thumbs up button on this video to help me out with the YouTube algorithm, and let's get into it. So by the way, I'm gonna be jumping around a little bit, especially at the beginning here, but I've actually structured this video in the order that I have very intentionally. But there's gonna be a few things, especially some things at the very beginning of this video, that might not completely make sense until later in the video. For example, pretty early on in this video, I'm gonna say something like, if you invested in an S&P 500 index fund over the last 30 years, you would have grown your money by 1,951%. And this is assuming that dividends are being reinvested at the time they're being received. And that this equates to about a 10% annualized growth rate. So I'm gonna say that to you coming up as part of something that needs to be explained early on, but there's a solid chance that you don't know what the S&P 500 is, and you don't know what an index fund is, and you may not even know what dividends are. And that's okay. But I do promise you that in spite of what I just said, that I have put everything in the best logical order so that everything builds on the thing that you just learned. And I also promise you, as you keep going through it, everything is gonna tie together. So yeah, I'm just kind of warning you that this might happen. You might get a little bit overwhelmed, but I'm not gonna leave anyone behind, and I promise you that everything will begin to connect and click into place as you continue going through it. And so if you start to get overwhelmed, just don't worry. Hang in there, because it's gonna be worth it. And finally, I'm gonna promise you that you will eventually reach a point where you're actually shocked at how simple this whole thing really is. And what I've done in making this video is I've tried to make literally the most valuable video that you'll ever watch on YouTube. Sound good? So let's get started with why we would want to invest. For me personally, I can say it's about gaining financial freedom, and it's also about gaining that financial freedom early in life. Now, everyone's gonna have their own definition of what financial freedom really even is, but for me, this is what it is. For me, it means having enough money invested that I can draw on that money an amount that I need to live comfortably, but for there to be enough money there invested that the total amount is still able to continue to grow in spite of me drawing the money from it that I need to live. For example, if I had $2 million and I was able to earn 10% annually on that money, which is by no means unrealistic, by the way, and we're gonna talk about how to do that coming up, but nonetheless, 10% of $2 million is $200,000. And if I only need $100,000 a year to live comfortably, then I can take that $100,000 from the total to live off of and still be left with $2.1 million. And so the total capital base has grown from $2 million to $2.1 million in spite of me taking the money from it that I need to live off of. And if that $2.1 million grows by 10% in the following year, that would now be $210,000. And if I were to draw my $100,000 from the total, my invested capital would be $2,210,000. And so in this scenario, I could literally take $100,000 from the total every year forever, and the total amount would still continue to grow forever. I could be long gone and my great-great-grandchildren could still be enjoying that $100,000 a year for their entire lifetimes as well. And all succeeding generations after them as well. Pretty cool, right? And actually, at the rate we're talking about here in this scenario, it wouldn't be long before I could start drawing $200,000 from the total every year, while the total would still be able to continue to grow. Can you see that? That'd be pretty awesome, right? So there's a couple things that I've touched on in this little scenario that I want to elaborate on now. The first thing is something called compounding growth. Or, as some people like to say, earning interest on your interest. The second is that 10% growth rate. In a minute, we're going to talk about what rate of growth is actually possible and achievable, and more importantly, how it's done. But before we can talk about anything else though, we got to talk about compounding growth and how it works. Because compounding growth is really the big secret to building wealth. As Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So $1,000 compounding at 10% annually would look like this. After the first year, you'd have a new total of $1,100. After the second year, you'd have a total of $1,210. After the third year, you'd have $1,331. By the fifth year, you'd have $1,611. By the 10th year, you'd have $2,594. By the 20th year, you'd have $6,727. By year 40, things start to get a little bit more interesting. That initial $1,000 one-time investment would now be worth $45,259. By the 60th year, it'd be worth $304,482. And after 100 years, that $1,000 invested will have grown to $13,780,612. And here's what that would look like visually. Notice the exponential growth curve. Now here's the same thing, but the second line on this chart now shows $1,000 growing by, instead of a 10% annual growth rate, an 11% annual growth rate. Notice how just a 1% change in annual growth rate causes such a dramatic difference over a long period of time. That's actually a 247% increase to the final result just because of a 1% difference annually. And even after just 50 years instead of 100 years, the difference in the final result because of the 1% difference annually is still 157%. So more than double the final result just because of a 1% annual difference. So the name of the game in investing is to 1, maximize the rate that you're compounding at, and 2, to maximize how long you're compounding for. Now we said that we want to reach financial freedom and that we want to reach it early in life, and that's why we're going to be focusing on that first part of maximizing the rate that we're compounding at. Now let's talk about what's possible in terms of what annual growth rate is realistic for you to be able to compound your money at. And to do so, we can start by looking at the performance of something called the S&P 500 index. Now this index, and don't worry if you don't know what an index is yet, but this index, the S&P 500, has kind of been collectively chosen by the people as the index that best represents the US stock market in general. And it's really just become the most popular index for people to compare their personal investing results against. And I'm not going to dwell on this point right now because it would actually be a little bit of a distraction at this particular point in your learning for me to start talking about what an index is and what an index fund is. But all you need to know at this point is that what we're about to look at is essentially what someone's investment returns would have been if hypothetically they were to have invested their money simply just spread out amongst the largest 500 US public companies over a couple different time periods. And if you're feeling confused, by the way, again, just stick with me because I promise that everything will start to click into place as we continue going forward. But for now, I'm just going to try to give you an idea of what's possible in terms of growth rates that you could compound your money at. Sound good? Over the past 10 years, so this means if you made an investment in July of 2011, roughly 10 years ago, spread out across the largest 500 US public companies, your invested capital would have grown by a total of 295% between then and now. And this assumes, by the way, that all dividends received in that time period were reinvested at the time they were received. And this equates to an annualized growth rate of 14.729%. And so that's the annualized growth rate over the past 10 years. If we go back further and we look at the past 30 years, so in other words, if you invested in July of 1991, your invested capital would have grown by a total of 1,951%. Again, that includes dividends being reinvested. And this equates to an annualized growth rate of 10.595%. If we go back further and we look at the past 50 years, so if you invested in July of 1971, your invested capital would have grown by a total of 17,730%. And again, this is assuming dividends being reinvested. And this equates to an annualized growth rate of 10.923%. I just want to point out at this time that although we've just seen that historically the annualized growth rates over different periods of time have been around 10 to 14% annualized, it's important to know that pretty much anything can happen in any given year. This chart here shows annual returns for each year between 1929 and 2020. And as you can see, there are years where your capital would have grown significantly in that year, but there are also years where your capital would have decreased as well. So anything can happen from one year to the next. But over the long term though, historically speaking, at least, your annualized growth rate would have been around about 10%, as we just saw. But now I need to throw a little bit of a wrench into the mix, because here's the thing with what I just said. Just because investing in stocks has historically provided annual growth rates of about 10% does not mean it's safe to assume that you'll be able to earn 10% annually in the future by simply just spreading your investment dollars amongst the largest 500 US public companies. As they say, past performance does not guarantee future results. And to illustrate this point, let's look at what happened in Japan over the past 50 years, just for a second. This chart here shows Japan's version of the S&P 500, which is called the Nikkei 225. And what you can see here is that between 1970 and 1990, the stock market grew massively in value. If you invested at the beginning of 1970, between then and when the market peaked in December of 1989, you would have increased your capital at an annualized rate of about 17%. And for the unfortunate people buying in 1990 thinking that they'd get another 20 years of 17% annual returns, they were severely mistaken. What happened during this period in Japan to cause this, by the way, was that the Japanese government progressively lowered interest rates eventually to extremely low levels. And during this time when interest rates were super low, it was both very easy and inexpensive to borrow lots of money. And so everyone was borrowing money at these super low rates and using that borrowed money to buy a lot of stocks. And all that buying demand drove prices higher and higher, which also created even more of a frenzy of even more buying from everyone who was more or less afraid of missing out. And this is what's called a bubble. And once the bubble popped at the beginning of 1990, everyone went rushing for the exit door all at once. And with no one buying and everyone selling, this change in the supply and demand balance caused prices to come crashing down. If you were unfortunate enough to have invested your money at the height of the bubble in December of 1989 and have hypothetically been holding on ever since, between then and now, with dividends being reinvested, your capital would have grown by a total of only 13%. That's total, which annualized is only a 0.4% growth rate annually. In other words, if you invested at the height of this bubble, it would have taken you approximately 31 years just to get back to where you were when you started. And it's actually even worse than that, because 31 years ago, the purchasing power of every dollar would have been significantly higher than it is today. To put that more simply, $1 million 31 years ago could buy a lot more than $1 million can today. That makes sense, right? So the reason I bring up Japan now is just to point out another reason why it's important to learn how to invest. Because there's some people that would tell you that the US stock market right now is in a Japan-like bubble. Now, my personal opinion on that is that we've still got quite a ways to go before we're in Japan-like territory. But if you're thinking that just buying the S&P 500 today will give you 10% annualized returns over the next couple decades, my guess is that would be a little bit over-optimistic. On that note, I want to share a short section of one of the books that I recommend called 100 Baggers. In the book, the author says this: just because a stock market index such as the S&P 500 is pricey doesn't mean you should give up on stocks. Unless you're a buyer of the index itself, it's not relevant to the business of finding great stocks today. Let me give you a historical example. 1966 to 1982. The big picture crowd likes to cite this 17-year stretch as dead money for stocks. The Dow Jones Industrial Average basically went nowhere. This performance was worse than it appears because inflation was high during this period. Thus, you might conclude you didn't want to be in stocks. But here's what my research on stocks that returned 100 to 1 found. There were 187 stocks that you could have bought between 1966 and 1982 that would have multiplied your money by 100x. In fact, during that 17-year stretch, you'd have had at least a dozen opportunities each month to multiply your money 100x if you just held on. All right, let's do a quick recap of what we've covered so far. We've talked about why it's worth it to invest. I've given you my definition of financial freedom. Remember, I said that for me, it's having enough money invested that you can draw from it the money you need to live, but the total amount still continues to grow forever in spite of me drawing from it. We've also talked about compounding growth and how it's the secret to building wealth. And just now, we've talked about what sort of annualized growth rates could be achievable for us by looking at how someone hypothetically would have done if they were to have just spread out their money across the 500 largest US stocks and held on over different periods of time. Now, we're just about to get into the practical details of how to invest and how the whole thing works, but I want to mention now one of the biggest mistakes that I see people make when it comes to investing, which is investing in assets that aren't able to compound. Gold is an example of one of those assets. Gold is what's called a non-productive asset. In other words, it's an asset that doesn't produce anything. To explain that better, I'll give you some examples of productive assets, which are able to compound money. So productive assets include things like businesses, farms, and rental properties. And so for example, if you own a farm and you own 100 acres of farmland, that farmland would produce crops every year which can be sold, and of course the money received could be used to purchase more acres of farmland. And if all the profits that the farm generated got put towards buying more acres of farmland, then the total number of acres would continue to grow at an exponential rate, and the profits the farm earned each year would also grow at an exponential rate. Can you see that? Same with rental properties. If you were to put all the profits towards buying more rental property units, your total asset value and the amount of profits generated each year would be growing at an exponential rate. And with businesses, same thing. If all profits get reinvested, the total asset value grows and the profits from them grow at an exponential rate. With gold though, there's no profits. If you buy gold, it just sits there until you sell it. So you can't make any money unless you sell it to somebody else. And when you sell it, technically that person buying from you at a higher price than you paid, whether they realize it or not, is just banking on somebody else coming around in the future and buying off of them for a still even higher price. It works sometimes, but it's not a way to build wealth. And to illustrate that point, let's just take a look at this chart. This is showing the past 10 years. The red line here represents how your wealth would have grown if you bought the S&P 500 index, but without dividends being reinvested. And remember, buying the S&P 500 just means spreading your money across the top 500 largest US public companies. And again, this line represents how your money would have grown if you did that, but assuming any dividends being received are not reinvested. The blue line is the same thing, but for the Dow Jones Index, which is just an index of a chosen 30 large and prominent US companies. And again though, this is how your money would have grown if you had spread out your investment dollars across these 30 companies at the beginning of this period, but without any dividends being reinvested. The yellow line here represents how your wealth would have grown over the past 10 years if it was invested in gold at the beginning of the period. And of course, there are no dividends when you buy gold because gold doesn't produce anything. And this gray line here represents how your wealth would have grown if it was invested in silver at the beginning of this 10-year period. Now this black line here represents how your wealth would have grown if it was invested in the Wilshire Large Cap Index, which is just an index of the 750 largest US stocks. So that means that it would include many of the stocks that are included in the S&P 500 and the Dow indexes. But the difference with this black line is that unlike the red and blue lines, it does account for dividends being reinvested. So this means that this black line here represents how your wealth would have grown if it was spread out across the 750 largest US companies and any dividends that you received were immediately reinvested. So the purpose of this graph that you're looking at is really just to illustrate the power of dividends being reinvested and investing in assets that can compound versus investing in non-productive assets like gold. It's less obvious when we look at the past 10 years, but if I increase the period of time that we're compounding over, that difference becomes more and more apparent. Over the past 30 years, the discrepancy is even larger. When we increase it to show the last 50 years, the difference dividends being reinvested makes becomes even more apparent. And here's the difference it makes when we look over 80 years and here's 100 years. Is this making sense? So all I'm doing here is illustrating again the power of compounding and why it's important to invest in assets that can compound. Gold can't compound. Things like art, Beanie Babies, sports cards, or Pokemon cards are also all things that you can't compound your money with. You could buy them in hopes of someone coming around and buying them from you in the future at a higher higher price than you paid, but you'll never be able to compound your money with them because they don't produce anything. All right, with all this dividend talk, it's time to talk about dividends. Something that happens to a lot of people when they learn about stock investing is that they become obsessed with dividends. They think it's all about dividends and that dividends are the only thing that matter. A stock's dividend yield becomes not just the most important thing to them, but it becomes the only thing. And I will explain what dividend yield is in just a minute, but I want to first explain why dividends are actually not that important. Berkshire Hathaway is a company that is also kind of known as Warren Buffett's company. And by the way, in reality, it's not just his company, but he does own at this point around 16% of the total number of shares that the company has, which naturally means that he owns 16% of the company. And even I actually own a percentage of this great company. Although it's a very small percentage, I do own a percentage of Berkshire Hathaway nonetheless. And the exact percentage that I own is actually 0.000018314%. Now, by the way, I just snuck in a little bit of a side lesson there. Did you catch that? The little lesson I snuck in was that when you own shares of a company's stock, it means that you own a percentage of that company. But we're talking about dividends here and why they're not that important, so let's get back to that. Berkshire Hathaway is one of many companies that has never paid a dividend. Actually, that's except for one single year that Berkshire paid a dividend in 1967, and Buffett has since joked that he must have been in the bathroom when that decision was made. But besides that one year, they've never paid a dividend since. And in spite of never paying a dividend, if you had invested in Berkshire Hathaway when Buffett gained a controlling ownership interest in 1965 and simply held on until today, you would have grown that invested capital by 2.8 million%. Which is an annualized growth rate of 20%. Now compare that to the returns of the S&P 500 with dividends included, which grew at an annualized rate of 10.2% and giving an overall gain of 23,000% if you invested at the beginning of this time period. So obviously you would have rather invested your money into Berkshire over this time period than to have had it invested spread out across the largest 500 US public companies, in spite of the fact that you would have never received a dividend from Berkshire, except for that one time in 1967, of course. So here's how dividends work. So first of all, the goal of any company is to make a profit. And a company is profitable when its total revenues earned are greater than the cost of goods sold and the expenses required to generate those revenues. So if a company earns $1 million of revenue, has cost of goods sold of $500,000, and has total expenses of $300,000, which would include all expenses from marketing costs to rent to employee wages, all expenses, well then it could be said that this company has earned a profit of $200,000. And this is the money that a dividend could be paid from. And this company could choose to pay out the entire $200,000 as a dividend, in which case it could be said that the company has a 100% dividend payout ratio, and that dividend money would be distributed to the shareholders, aka the owners of the company, proportionally to how much of the company they own. Paying dividends, though, is not the only thing that a company can do with its profits. There are 5 different things that a company can do with its profits. If the company happened to have any debt, it could use those profits to pay down the balance on that debt. If the company had an opportunity to expand by opening up new locations, for example, and it felt that it would be a wise use of money if it did so, then it could use profits towards expanding in this way, with of course the ultimate goal of generating even more profits in the future. The company could also use profits to just straight up buy another business, or even just a percentage of another business. This, by the way, is the option that Warren Buffett has primarily chosen to go with when it comes to the profits that have been earned by Berkshire Hathaway. And then the last option available for how a company can use its profits is to use that money to purchase its own shares. The goal of this one is that the shareholders benefit from it because as the total number of shares that the company's ownership is divided up amongst decreases, it means that the percentage of ownership that each individual share represents increases. The best analogy for this one is that it's like buying out business partners. If 10 people start a business and each own 10% of the business, but after some time, one of those business partners wants out, all 10 owners could vote on and decide to use some of the company's profits to buy out that 10th person. The company would therefore be left with a total of 9 owners, and each of those owners would own 11.1% of the company. And this could theoretically continue until there was just one owner left who owned 100% of the company. Nonetheless, the point here is that dividends are just one way that a company can use its profits, and it's often not the most efficient way for a company to use its profits either. And so for you as an investor, receiving dividends and reinvesting that money is not a requirement that must be met if you want to be compounding your wealth through investing in stocks. And the truth is that if the management of the company that you're a shareholder of has the ability to reinvest profits and earn higher rates of return on that money than you could, then it would make sense for your preference to be that the company doesn't distribute that money to you as a dividend and instead goes ahead and reinvests it. And you would be better off if that's what happens. This chart here comes from another one of my favorite investing books called The Outsider CEOs, and it shows how $1 invested would have grown over a period of time. This line represents how a $1 investment would have grown if it was hypothetically spread out amongst the stocks of the 8 companies that are detailed in this book. This line represents how a $1 investment would have grown if it was hypothetically spread out amongst the stocks of the competitor companies of the 8 outsider companies. This line represents how a $1 investment would have grown if it was invested in General Electric Company over the period that Jack Welch was the CEO. And the reason this one has been thrown into the mix is because Jack Welch is generally thought of as being one of the best CEOs. So putting him in here is a way of further showing just how much better these guys were. And then this line here represents how a $1 investment would have grown if it was hypothetically spread out amongst the largest 500 US public companies. Now, when I saw this and when I read this book, it seriously opened my eyes to the power of superior capital allocation. This table here shows the 8 CEOs that are detailed in the book, and this column shows how they thought about dividends. And you can see that all of them either paid no dividends or paid low dividends. This column shows that they all bought back 30% plus of their company's shares, except for Buffett. However, guess what Buffett's been doing lately? This book was written in 2012, but since about the end of 2019, Berkshire Hathaway has been pretty aggressively buying back shares. So I'm not going to cover the rest of this table, so if you want to pause the video and take a look at it, go ahead and do that now. Nonetheless, you now know that dividends are not the most important thing when it comes to successful investing, but let's talk about what is. And here it is. The most important thing is paying a good price relative to the value of what you're getting in exchange. Warren Buffett has a quote where he says, "Price is what you pay, value is what you get." What this means is that just because a business is a great business does not make it a great investment. A lot of people seem to understand this point more easily when it comes to thinking about buying a rental property. If you were to be buying a rental property as an investment, regardless of how incredible the property was or even how much money the property made, there would be a price that you could pay that would simply just be too high of a price for it to be a sensible and smart investment. So how great or how bad an investment is really comes down to the price you pay for it. That makes sense, right? So successful investing is all about paying bargain prices. Whether it's businesses, rental properties, farmland, etc., you want to be a bargain shopper. You want to be a discount buyer. This is Benjamin Graham. He was Warren Buffett's teacher, and he wrote this book called The Intelligent Investor. And by the way, if you're a beginner, I actually don't suggest that you read this book. It's a good book, but it's extremely dense, and again, I've seen people make the mistake of thinking that they need to read this specific book before they can start investing, but the book ends up getting shelved because it's so hard to read and they end up never starting investing. So honestly, don't even worry about buying this book right now. But I bring it up because in this book, there's a chapter which Warren Buffett says is the most important chapter for any stock market investor to read and to understand. And that's chapter 8, and the chapter is called The Investor and Market Fluctuations. Near the end of the chapter, he provides us with an analogy for the stock market, the famous Mr. Market analogy. And again, this is the most important thing to understand when it comes to stock investing. Here it is. Owning shares of a publicly traded company can be thought of as being the exact same thing as owning a small share in some private business that costs you $1,000, for example. One of your business partners is a fellow named Mr. Market. Every day, Mr. Market comes to you and tells you what he thinks your interest in the company is worth. And furthermore, he offers to either buy you out at that price or to sell you more more shares based on that valuation. Sometimes his idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or fears run away with him, and the value he proposes seems to you a little short of silly. And this is literally no different than what you experience when you own shares of a publicly traded company. And this is actually what makes the stock market so incredible. As an intelligent stock investor, you can take advantage of these market fluctuations by using opportunities to buy shares of a company when they're trading at bargain prices. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other person's mistakes of judgment. Honestly, you might want to go back and listen to that again. What I just said is so important. The truth is that the daily or monthly or even sometimes yearly fluctuations in the price of stocks that you own don't make you richer or poorer. Benjamin Graham says, "In the short run, the market is a voting machine. In the long run, it's a weighing machine." And that sentence is the basis of what Warren Buffett says is the most important thing for stock investors to understand. Joel Greenblatt is another famous investor who has achieved 40% annualized returns over the past 20 years. And he says that if you do good valuation work, Mr. Market will eventually agree with you. He's a money manager, but on the side, he gives back by teaching a value investing course at Columbia Business School, the same school that Benjamin Graham taught Warren Buffett at. And at the beginning of the semester, he tells all of his students that if their analysis is correct, it can take only a few weeks or a few months, but usually 2 or 3 years is all the time that they'll have to wait for Mr. Market to reward their bargain purchases with a fair price. This means, guys, that stock investing is all about valuing companies and then buying shares of it when they're trading at bargain prices. Or at the very least, just not overpaying. Now, the reason stock prices can sometimes trade at prices that don't resemble what they're actually worth is because a stock's price at any given moment is just based on whatever it last traded for. And people are very susceptible to being both overly enthusiastic and overly pessimistic and scared. And besides that, most people are really just following the herd and aren't really actually considering what a stock is worth relative to the price that it's trading at. Now, there's a theory out there called the efficient market theory, and this theory is actually in complete opposition to what you just learned about Mr. Market. This theory says that there are never any overvalued or undervalued stocks ever, because there are smart stock analysts out there who utilize all available information to ensure unfailingly appropriate prices always. The main proponent of this idea wrote a book called A Random Walk Down Wall Street. And he also proved to the satisfaction of an Ivy League intellectual community that a monkey randomly picking stocks has just as much of a chance as beating the market as anyone, including the likes of Warren Buffett or anyone else. And according to this theory, anyone that achieves above average results consistently over a long period of time is just getting really lucky. Now, that entire book, by the way, could have just been summarized in one chapter. It basically just tells you to buy low-cost index funds, and that's about it. And now, in spite of this book being in its 12th edition and continuing to spout the same efficient market theory idea to this day, and in spite of this theory being taught in many business schools all over the world still to this day, the author was actually interviewed in 2003, and something funny happened. And this took place shortly after the year 2000 dot-com bubble, by the way. So the interview said to him this: "Now, a lot of people have said that the great bubble of the late 90s, when stocks went sky high for no identifiable reason, and then in early 2000 plunged for no identifiable reason, shows that the efficient markets idea is bunk." To which he replied, "In the long term, I think that they are generally efficient, though I'll admit they do go crazy from time to time." So in other words, he doesn't actually believe that the stock market is perfectly efficient always. Interesting. All right, now I'm going to play a very short compilation of Warren Buffett and Charlie Munger commenting on the efficient market theory, and then we're going to come back and we're going to get down to the job of how to value a business.
You know, it's really quite useful if you had a merchant shipping business, if all of your competitors believe the world is flat, it is a huge edge, because they will not take any cargo to go to places that are beyond where they think they will fall off. And so we should be encouraging the teaching of efficient market theories in universities. And it's hard, though, it's very interesting. It's hard to dislodge a belief that becomes the dogma of a finance department. It's so challenging to them, and they have to, at age 30 or 40, to go back and say what I've learned up to this point and what I've been teaching students and all of that is silly. That doesn't come easy to people. What investment is about is valuing businesses. I mean, that is all there is to investment. You sit around and you try to figure out what a business is worth, and if it's selling below that figure, you buy it. That, to my, you can't find a course virtually in the country on how to value businesses. You can find all kinds of courses on how to compute beta or whatever it may be, because that's something the instructor knows how to do, but he doesn't know how to value a business. So the important subject doesn't get taught, and it's tough to teach. I think Ben Graham did a good job of teaching it at Columbia, and I was very fortunate to run into him many decades ago.
All right, so now I'm going to explain to you how to value a business. The intrinsic value of a business is equal to the sum of the present value of all the future cash flows that could be taken out of the business in its lifetime. And of course, I don't expect you to understand what I just said yet, but that is the all-important equation for how to value a business. It should be said right now that you'll never be able to calculate the exact intrinsic value of a business, and you'll soon see why that doesn't matter. But the reason you'll never be able to calculate the exact intrinsic value is because intrinsic value is based on the future cash flows that could be taken out of the business, and of course, there's no way of seeing what the future holds. So intrinsic value will always be an estimate. And Warren Buffett says that even him and his business partner Charlie Munger would come up with different numbers for the intrinsic value of a business, although they would be likely very close. So let's do an example, but for this example, we're going to pretend that we are magically able to see exactly 100 years into the future. And so this means that we know exactly what the future cash flows of any business will be for the next 100 years. And we're going to value a bakery business. And because we know what the next 100 years of its future entails, we know that this business will generate $100,000 of free cash flow next year, and that the following year it will generate $110,000 of free cash flow, and we know that it will continue to grow its free cash flow by 10% every year until year 11. At which point, unfortunately, some competition comes in from some other bakery businesses, and the free cash flow that this bakery business generates will actually begin to decrease by 5% each year from that point forward. So here are all the cash flows of this business for the next 100 years. And if we were to add up this column, the total sum would be just over $6 million. $6 million, however, is not the number that we care about though. And this is because we need to figure out what the present value of each of these future cash flows is, and then find the sum of those numbers. Remember, we said that the intrinsic value of a business is equal to the sum of the present value of the future cash flows. Now, the reason that we care about the present value of these future cash flows is because of something called the time value of money. Do you remember earlier in this video when we were talking about the Japanese stock market and I said that $1 million 31 years ago could buy a lot more than $1 million can today? You remember that, right? Well, the reason for that is because of the time value of money. For one, inflation, which is just the increasing of total money supply, devalues money every single day, but it's actually even more than that. See, if somebody asked you, would you rather have $100 today or $100 in 1 year from now? The answer is that you'd rather have $100 today. Because if you give me $100 today, I could invest that money and I could have $120 in a year from now. And if it's true that I can invest money at a 20% annual growth rate, then $100 a year from now actually has a present value of only $83.33. And that's because if you give me $83.33 today and I grow it by 20%, then in a year from now, I would have $100. So when we say that the present value of next year's $100 is $83.33, we've used what's called a discount rate of 20%. And now check this out, and this is super important. We're about to use the present value formula to discount the bakery's future cash flows back to their present value. Now, a lot of people get hung up on what discount rate they're supposed to be using, but as you'll see in a minute, this isn't something you need to worry about. What I want you to do is I want you to think about the discount rate as essentially just the annual rate of return that you'd like to achieve with your investment. So if you've decided that you want to achieve no less than a 15% annual return on your investment, then you would use a 15% discount rate when you're figuring out the present value of future cash flows. So this is the present value formula, but don't get overwhelmed if math scares you, because I promise you this is extremely simple. Present value is equal to the future cash flow divided by 1 plus the discount rate to the power of the number of years that you're discounting back. And this is the formula that I've used to populate this present value column. And I will, by the way, put a link in the description of this video to this spreadsheet so you can play around with it yourself. But I'm also going to explain in a minute why using a spreadsheet is not 100% necessary, although using one can be thought of as kind of like training wheels. So these are the present values of our future cash flows. And if we add them up, we get a total sum of $994,586.14. And what this means is that if we paid this $994,000 amount for this bakery business today, then we'd be making an investment that would provide us with 15% annual returns. And if this business had, for example, 500,000 shares, then we could divide the value by the number of shares and figure out that the per share intrinsic value is $1.99. And so this equally means that if we were to buy shares of this business for $1.99 each, that would naturally also be an investment that would provide us with 15% annual returns. Cool, right? And if we could buy shares of this business for less than $1.99, then our annual rate of return would be higher than 15%. And if we paid more than $1.99 per share, then our annual rate of return would be lower than 15%. That makes sense, right? And if we were okay with only getting an 8% annual return, for example, we could change the discount rate to 8%, and we would now find that if we paid $3.61 per share, then buying shares of this bakery at that price would be an investment that would give us an 8% annual return on investment. So now let's do a real life example using Facebook stock. And we want to start out by finding how much free cash flow Facebook has generated over the past 12 months. And we could do this by going into their investor relations website and finding it on their recent financial statements. But for now, an easier way to see this information is on a website like Yahoo Finance or Morningstar. From Morningstar, you can look up any company, go to the key ratios tab, and click full key ratio data. Here you can find a bunch of key financial information, including how much free cash flow the company has generated over the past 12 months. TTM is short for trailing 12 months. This number is in millions, so what this means is that Facebook has generated $32 billion of free cash flow over the last 12 months. We also want to know how many shares outstanding Facebook has right now, which we can see here is just under 2.9 billion shares, because again, this is in millions. And then we also want to know the rate at which the free cash flow has been growing year over year up until now. And we can see that here, of course, and if we went over to the financial statement tab and we went to the cash flow statement and scrolled down, we could see how it has grown more visually by hovering our mouse over this graph icon. But if we go back to the key ratios tab and we scroll down to this growth rate section, we can see how revenues, operating income, and net income have grown over the years. Let's focus on this column and we can see the year over year growth rate, the 3-year average annual growth rate, the 5-year average annual growth rate, and the 10-year average annual growth rates. And this is telling us that growth rates have been anywhere between 17% annually to 50+% annually. So we're going to use all this information now that we just gathered from Morningstar to predict how Facebook's free cash flow might look in the future. And with the goal of staying conservative in our future estimates, we're going to be using a 15% growth rate for the next 10 years for our estimates. And so here's how that looks in this spreadsheet, and I'll walk you through it. Here we have the growth rate for the first 10 years, which we've estimated will be 15% annually. In year 11 and beyond, we still have in here that free cash flow will decrease by 5% annually. And we are going to adjust this one in just a second, by the way, to see how the numbers change. And we still have a discount rate of 8% being used here. And based on all of this, it means that the intrinsic value of Facebook is $900 billion. And since Facebook has 2.8 billion shares outstanding, it means that the per share intrinsic value is $312. Cool, right? And if we go ahead and pull up a Facebook quote to see what the current market price is, we can see that the market cap is a little over $1 trillion and the market price per share is $380.78. Market cap, by the way, can also be thought of as what the market thinks the entire company is worth. And it's just simply the current price per share multiplied by the number of shares outstanding. All right, so since Facebook is trading at $380 per share right now, and we've just calculated that it's worth $312 per share, it means that based on our estimates of future free cash flow, it's not a good buy. However, what if this is not realistic though? Like, what if we're being too conservative in our estimates? For example, if instead of saying that growth rates in years 11 and beyond will be -5%, what if we said that instead growth will just flatline and we change this to 0%? Well, we can see that now, as long as we paid less than $420 per share, we'd be able to get 8% annual returns or higher, assuming our free cash flow predictions are accurate. Now, Facebook isn't an example of a very clear and obvious great stock pick right now. Over the past year, however, Facebook has traded as high as $382.76 and as low as $244.13 per share. And I actually bought some earlier this year when it was trading around $259. Not a lot, but I did have some extra money to invest, and I decided that it was a good buy at that price relative to all the other investment opportunities available at that time. And what I just said is actually an important thing about investing in general. It's all about comparing potential investments to all the other currently available investment opportunities. We've of course only looked at one company, but if we were to look at 20 different companies, we'd quickly start to get a feel for what investment returns are actually possible right now. Peter Lynch is another investor with crazy high investment returns of 30% plus annually over extended periods of time. And something that he says is, if you look at 10 companies, you'll find one that's interesting. If you look at 20, you'll find 2. If you look at 100, you'll find 10. The person that turns over the most rocks wins the game. Now, the next question to answer is how to find potential opportunities and where to look. Now, I personally use a stock screener called Guru Focus, and I will put a link in the description if you're interested. However, Joel Greenblatt has been nice enough to provide an absolutely free stock screener over at magicformulainvesting.com. And the screener works like this. All US public companies are ranked by a combination of 2 factors. The first is based on their returns on invested capital. Companies with high returns on invested capital will be ranked higher. Second, companies are ranked by their current price in relation to how much profits they've generated over the last 12 months. And companies with lower prices relative to how much profits they've generated over the last 12 months will rank higher. I like to call it the greatness ranking and the cheapness ranking. So companies like Google might rank high in the returns on invested capital ranking, but would generally rank pretty low in the cheapness ranking. The magic formula combines these rankings so that the highest ranking companies will be a combination of both great and cheap. The only parameters you can adjust in this screener are the minimum market cap and the number of stocks that you'd like to see. Now, at any given time, there's going to be about 250 stocks across the range of market caps showing up in this screener. And it should be said that Joel Greenblatt himself uses the magic formula results as his starting place for researching stocks. Now, typically for him, 5 stocks make up 80% plus of his portfolio at any given moment. But for someone starting out, I might suggest 10 to 20 stocks as a starting place. Now, another place to find ideas is valueinvestingclub.com, which is a website that was also set up by Joel Greenblatt. And on this website, people do write-ups for potential stock opportunities, and Joel Greenblatt actually awards $5,000 to the person with the best idea every single week. And these write-ups are available to the public. Now, as for when to sell your stock, that's actually a huge subject in and of itself. And even Charlie Munger himself, funny enough, has said that he hasn't quite figured that one out. But what him and Buffett have said is that you shouldn't buy a stock unless you'd be okay with holding it for at least 10 years. And they've also said that their preferred holding period is forever. However, they will sell if they've realized they've made a mistake, or they will sell if the fundamentals of the business and its future prospects have have significantly changed. But as long as the business continues to be great, even if the market has priced it to be significantly overvalued, Buffett and Munger still tend to prefer to just continue holding on. Now personally, I prefer to just model after these guys and hold my stocks pretty much forever, and that's generally what I would suggest as well. And I do go into a little bit more detail on when to sell your stocks in other videos on my channel as well. Now to buy your first stock, you're gonna wanna set up a brokerage account. And I have links in the description to the brokers that I suggest, whether you're located in the United States or in Canada. The actual buying process itself isn't complicated. I like to use limit orders, and I set my limit price at whatever the ask price is, and my order is usually filled pretty much right away. Now for the next phase of your learning process, I've put together a playlist that I think is best for you to go through next. Now besides going through this playlist, my suggestion would be to buy a copy of each of the books that I have linked in the description, and also to watch all of the past Berkshire Hathaway annual shareholder meetings, which you can find here on YouTube. If you watch my channel, read those books, and watch those annual meeting recordings, I do believe that you're gonna be well on your way to getting far superior investment returns than anyone you know, and you're also gonna be able to retire long before they do as well. I'll see you over in this next video, and thank you so much for watching to the end. You are amazing. Thank you.